Hello, everyone. Welcome to the mad world of accounting. I'm your host, Marcus Thomas. Today, we will be talking about classifying assets and liabilities. Before we get started, please like the video for the algorithm. Okay, here we go. Now, from our last video about the basics of accounting, we know that assets are anything tangible or intangible that has economic value to its owner or could have economic value in the future. The common types of assets include current, non-current, physical, intangible, operating, and non-operating. Correctly identifying and classifying these types of assets is critical to the survival of a company, specifically its solvency and associated risk. Classification of assets are based off of convertibility, classifying assets based on how easy it is to convert them into cash. Physical existence, classifying assets based on their physical existence, other words, tangible versus intangible assets, and usage, classifying assets based on their business operation usage. Current assets are assets that can be easily converted into cash and cash equivalents, typically within a year. Current assets are also termed liquid assets, and examples of such are cash, cash equivalents, short-term deposits, accounts receivables, inventory, and office supplies. Non-current assets are assets that cannot be easily and readily converted into cash and cash equivalents. Non-current assets are also termed fixed assets, long-term assets, or hard assets. Examples of fixed assets are land, buildings, machinery, equipment, patents, and trademarks. Tangible assets are assets with physical existence. We can touch, feel, and see them. Intangible assets are assets that lack physical existence. Examples of tangible assets include cash, land, buildings, machinery, and equipment. Examples of intangible assets include patents, copyrights, trademarks, and brands. Operating assets are assets that are required in the daily operation of a business. In other words, operating assets are used to generate revenue from a company's core business activities. Examples of operating assets are cash, accounts receivable, inventory, buildings, and equipment. Non-operating assets are assets that are not required for daily business operations, but can still generate revenue. Examples of non-operating assets include short-term investments, marketable securities, vacant land, and interest income from a fixed deposit. A liability is a quantity of value that an individual or business owes and is expected to deliver in the future. Common types of liabilities include current liabilities, which are obligations due within 1 year of the operating cycle, non-current liabilities, which are debts and obligations due in more than 1 year, and contingent liabilities, which are potential obligations that depend on the outcome of a future event. Current liabilities are obligations due within 1 year of the operating cycle. Examples of current liabilities include accounts payable, which is money owed to suppliers for goods or services, short-term debt, which are balances on credit lines or notes payable soon, accrued expenses, which are expenses incurred but not yet paid, like salaries, interest, or taxes, deferred revenue, which are payments received from customers for products or services not yet delivered, and payroll liabilities, which are wages and related taxes owed to employees. Non-current liabilities are debts and obligations due in more than 1 year. Examples of non-current liabilities are long-term loans, which are bank loans with repayment over several years, bonds payable, which are debt securities issued by the company, lease obligations, which are commitments for long-term leases, pension liabilities, which are obligations to fund employee pensions, and deferred tax liabilities, which are taxes expected to be paid in future periods. Contingent liabilities are potential financial obligations depending on future events. The most common contingent liabilities are outstanding lawsuits, debts, product warranties, and pending investigations. Now, in this portion of the video, we will go over practical examples of how to classify assets and liabilities. Example 1. A recent deposit of $15,000 to your company's account. Well, we know that this will be an asset, but what type of asset will it be? The answer is a current asset. Remember, current assets are things that can be converted into cash within 1 year. Example 2. An investment of $500,000 to an AI stock. Well, we know that this will also be an asset. What type of asset will it be? That's right, it's a non-current asset. Non-current assets are expected to provide economic benefits longer than a year and aren't easily converted into cash. Example 3. A 5-year lease on an office building equaling $400,000. Now, this will be a liability. But what type of liability is it? That's right, it's a non-current liability. Non-current liabilities are debts and obligations due in more than 1 year. Example 4. Internet bill in the amount of $150, which is due at the end of the month. This is another liability, but what type of liability is it? You guessed it, it is a current liability. Current liabilities are obligations due within 1 year of the operating cycle. So, that is it for today regarding classifying assets and liabilities. If you enjoyed the content, please make sure to like, comment, and subscribe. Until next time, have a good day.